Welcome to Griffonomics.
Glad to be here for this one.
Yeah, so today we're taking you on a really highly specialized deep dive. We're looking at a series of investigative reports, investor day presentations, and some deep financial analysis.
Right, and the focus is LandBridge.
Exactly,
Yeah.
LandBridge. So I want you to picture, just for a second, a patch of bone-dry, dusky dirt out in West Texas.
Just absolute middle of nowhere.
Yeah, literally nothing but scrub brush, heat waves, maybe a couple of oil pump jacks nodding in the background. To the untrained eye, it's just barren wasteland.
But the reality of what's happening underneath and on top of that dirt is, well, it's insane.
It's unbelievable
Sure.
because today's mission is to unpack how that exact same patch of dirt is transforming. It's going from a traditional, pure oil and gas surface play into the literal irreplaceable bedrock for the global AI revolution.
Yeah, which sounds like hyperbole, but when you look at the math, it's actually happening.
Right. They are rapidly evolving into this high-margin powerhouse. It's water management, it's digital infrastructure, it's gigawatt-scale power generation.
Taking the desert and turning it into a computational engine.
Exactly. And honestly, my enthusiasm here is just, how unexpected is this pivot? You don't think West Texas dirt and then immediately think hyperscale AI data centers.
No, you definitely don't. And I think, just to ground the conversation right from the jump, we have to look past the sort of superficial real estate narrative.
Right. It's not just flipping land.
Exactly. This isn't just a speculation play where they buy cheap dirt and, pray the market arbitrarily decide it's worth more.
Like hoping a highway gets built nearby or something.
Right, exactly. The sources we're analyzing today, they describe an incredibly intricate ecosystem. It's this masterclass in capital-light value extraction.
Capital-light value extraction, that's kind of the golden thread running through all these documents.
It is. And it sounds like a paradox, right?
Yeah.
Because when you talk about heavy industry,
Pipelines, power plants, data centers.
yeah, you think billions of dollars in CapEx.
Yeah.
But looking at the 2026 Investor Day presentation, LandBridge has the math to back up this capital-light approach.
Yeah, David Capobianco, the chairman of LandBridge and CEO of 5 Point Infrastructure, he actually uses a very specific phrase for this.
The Vortex of Value.
The Vortex of Value, right. It sounds like a sci-fi movie, but what is the actual mechanic of that vortex?
Well, it's a deliberate choice of words.
Yeah.
To grasp it, you have to look at the broader 5 Point infrastructure platform that he masterminded. There are 3 pillars.
Okay, lay it out for us.
First, you've got LandBridge, obviously. They hold over 315,000 acres of surface and subsurface rights.
Mostly in the Delaware Basin, right? Along the Texas-New Mexico border.
Exactly. Highly strategic placement. Second, you have WaterBridge, which is their affiliate company that handles water infrastructure and management.
And the third?
PowerBridge. That's their newly formed arm dedicated to digital infrastructure and data centers.
Okay, so LandBridge is basically the foundational hub. They sit dead center in this vortex, providing the physical canvas for the other two.
Right. They commercialize those 315,000 acres, but, and this is the crucial part, they do it without bearing the massive capital expenditures.
They aren't paying for the concrete and the steel.
Nope. And the financial engine driving this is wild. If you look at their first full year of operations in 2022 and project to 2025, they've hit a 63% adjusted EBITDA CAGR.
That's a compound annual growth rate of 63%. That is massive.
It brings them to $177 million in adjusted EBITDA for 2025. But the real jaw-dropper is the margin.
Right. The FCF, the free cash flow margins.
Consistently hitting 60% to 70% FCF margins.
Which, wait, for an industrial or infrastructure-adjacent company, maintaining 70% margins feels like it's defying financial gravity.
It totally defies gravity until you look at those affiliate relationships. The reason the margins are so high is because WaterBridge and PowerBridge are acting as these operational shields.
Meaning they take all the financial risk.
Exactly. If a massive new pipeline needs to be laid down or a water treatment facility gets built, WaterBridge deploys the hundreds of millions in CapEx.
And if it's a data center pad, PowerBridge spends the money.
Right. LandBridge just provides the surface access, the right-of-ways, the subsurface rights.
And in return, they just collect toll booth money, basically.
Highly predictable, phased revenue streams. They get the initial lease option payments. They get paid for construction damages the second earth is moved.
Wait, really? Just for moving the dirt?
Yep. Then they collect ongoing surface lease revenues and, most importantly, long-term royalties on whatever water or power flows across that geography.
The analogy that comes to mind is like It's like owning the land under a gold rush boomtown.
That's a great way to put it.
You aren't paying for the picks and shovels. You aren't risking your own cash to build the hardware store. You just charge rent to the hardware store, and then you take a royalty on every ounce of gold they pull out.
Exactly.
But, okay, let me push back here for you guys listening. From a strictly investor perspective, how do we know they aren't just, financially engineering this?
What do you mean?
Like, how do we know they are actually increasing the value of the dirt and not just aggressively buying up adjacent, already profitable land to pump up their top-line numbers?
Yeah, the institutional market asks that exact same question. And management tracks this using a metric called SUE.
Surface use economic efficiency.
Right. It represents the average non-mineral revenue generated per acre across the portfolio.
Okay, so it ignores the actual oil and gas royalties.
Correct. And during the Investor Day, the CFO, Scott McNeely, broke down this SUE metric on a vintage basis, meaning they isolate the performance of the land based on the year they acquired it.
Oh, that's smart. So it strips out the new acquisitions.
Exactly. So looking strictly at their legacy 2021 acreage, the SUE grew from $465 per acre in 2022 to $11,159 per acre in 2025.
Wow. So that's pure organic growth. The exact same footprint more than doubled its yield.
Unadulterated growth. It proves their active management works. They're just finding more and more ways to squeeze value out of the same plot of dirt.
And the report says they're eventually targeting $2,500 to $3,500 per acre, right?
That's the public target, yeah.
Okay, so the SUE metric proves they are extracting more value. But to understand how they're doing that, specifically with those 2025 numbers, we actually have to look underground.
Literally beneath the surface.
Right, because the investigative reports highlight this massive structural bottleneck in the Delaware Basin. They call it the pore space crisis.
And just to clarify for everyone, this has nothing to do with finding oil.
No, it's about what comes up with the oil.
Exactly. The biggest constraint for operators down there right now is the produced water. For every barrel of oil you pull up, you're usually pulling up multiple barrels of this highly saline toxic brine.
Heavy metals, nasty stuff. You can't just dump it in a river.
No, absolutely not. The standard procedure is you have to inject it back deep underground into specific geological rock formations. You use the natural pore space in the rock.
But the reports map out a huge problem with this right along the Texas-New Mexico state line.
Yeah, they are hitting a geological wall. The traditional disposal zones are becoming severely overpressurized.
Because they've been pumping millions of barrels of liquid into a confined space for years.
Right. Fluid doesn't compress easily.
Right.
So the pressure builds up, the rock slips along fault lines, and you get induced seismicity. Earthquakes, which causes New Mexico regulators to crack down hard. The industry is currently looking at losing roughly 2 million barrels per day in disposal capacity over the next 10 years.
That's a massive loss of capacity. If they can't dispose of the water, they have to shut down the oil wells, right?
Exactly. It's an existential threat to production in that specific area.
And this is where the synergy between LandBridge and WaterBridge kicks in and just prints money.
It is a massive financial engine.
Yeah.
Because while the operators near the state line are panicking and losing capacity, LandBridge is sitting just across the border with vast contiguous tracts of deeply underutilized pore space.
It's low pressure, unencumbered rights.
Yep. According to their internal models, LandBridge has a 5 million barrel per day excess capacity opportunity.
5 million. And WaterBridge already built the heavy-duty pipelines to move that water away from the danger zones right into LandBridge's sinks.
Exactly.
I mean, think of the pore space like a giant underground sponge, right?
It's perfect.
The sponge near the state line is completely soaked. It's under immense pressure. If you force one more drop in, you trigger a seismic sensor and you're shut down. But LandBridge just has this massive dry sponge waiting miles away.
And the oil companies have zero alternative. They have to pay the toll to use LandBridge's sponge if they want to keep their multi-million-dollar wells pumping.
Let's talk about the money there, because the financials are staggering. At current rates, which are about 0.15 cents per barrel, that excess capacity represents an estimated $300 million in free cash flow for LandBridge over the next 5 years.
Just for burying water.
Just for granting access to empty space.
And you have to remember, that $1  15-cent rate is not a permanent ceiling.
Right, the economics of scarcity.
Exactly. Treating it as static fundamentally misprices the asset. Capobianco made it very clear in the Q&A. As regional disposal becomes more constrained, the market price for royalties is going to inflect upward.
We've actually seen that on the physical infrastructure side, haven't we?
Yeah, the report notes that WaterBridge's historical gathering fees, were around 0.65 per barrel. But on their newer long-haul solutions, like the Speedway pipeline built specifically to evacuate water from those pressurized New Mexico zones, they're commanding $1 to $1.25 per barrel.
Wow. So as the crisis worsens, the pristine pore space LandBridge monopolizes gets exponentially more valuable.
Exactly.
Okay, so they have this brilliantly profitable monopoly on wastewater. But if you're listening to this, you're probably thinking, if they're making hundreds of millions burying toxic water, why are we talking about AI and data centers?
Right. Where does Silicon Valley meet a West Texas water dump?
Exactly.
Well, that intersection is the pivot point for the entire company, because it turns out water management is no longer just an environmental headache for oil guys.
It's tech infrastructure.
In the era of massive AI models and generative AI, water is the lifeblood of compute.
Because of the heat.
Right. Processing billions of parameters across tens of thousands of GPUs generates staggering thermal energy. You cannot run a gigawatt-scale data center without phenomenal cooling, and for that you need water. Vast amounts of it.
Which brings us back to the surface and this whole PowerBridge architecture. They have a 15 gigawatt digital infrastructure roadmap.
15 gigawatts. It's massive.
It is. And their strategy is really specific. They call it the powered campus model.
Yeah.
But we need to be clear about what PowerBridge is actually doing here versus what the tech companies do.
Yeah, it's a huge distinction. PowerBridge is not pouring the concrete for vertical data center buildings. They aren't buying NVIDIA chips. They aren't managing server loads.
They aren't doing the internal network racks.
No. They are acting as the ultimate site prep provider. They deliver fully integrated, pad-ready sites.
The heavy civil and electrical base layer.
Right. They do the massive earth moving. They pre-install the high-voltage private use networks, the PUNs. They secure on-site power, route the water, lay the fiber optic conduits.
So they build the hyper-resilient neighborhood, and then Amazon or Google just drops their modular servers onto the pad, plugs in, and starts training models.
Exactly. It's a turnkey solution for hyperscalers.
And the scale of their flagship site is just, it's hard to even wrap your head around. The Alpha Digital Campus, it's 3,000 acres near Pecos, Texas.
Just massive.
Designed initially for 2 gigawatts of capacity, expandable to 3 gigawatts, and they have 5 of these target campuses mapped out across their acreage to hit that 15 gigawatt roadmap.
And the reason a tech giant would even consider putting 3 gigawatts in Pecos, Texas, comes entirely back to the water advantage.
Right. Tell us about the groundwater rights.
The presentation highlights that LandBridge controls 13.4 million acre-feet of groundwater.
Which the analysts quantify as roughly 6.6 million Olympic swimming pools.
Yeah, an unfathomable amount of water. Because they have that, they can offer hyperscalers something called open-loop cooling architectures.
Okay, let's unpack the physics of that, because the cooling engineering is where the real margin is made.
Absolutely. In legacy markets like Northern Virginia or Santa Clara water is severely constrained by the local municipalities. So data centers are forced to use closed-loop chilled water systems or massive air cooling fans.
And those systems are incredibly parasitic to the power load array.
Completely parasitic. You burn a massive percentage of your expensive electricity just running mechanical chillers to keep the silicon from melting. It's terribly inefficient.
But open-loop cooling, which LandBridge can support because they can just pump 300,000 barrels of water a day to a single campus, relies on evaporation.
Right. Massive flow rates, rejecting heat into the air, no heavy mechanical chillers. Open-loop systems can save 10% to 30% of your total power capacity compared to closed-loop.
That's incredible. If you have a 2 gigawatt campus and you save 20% of your power load and redirect that electricity back to actual GPUs,
that is worth an absolute fortune to a hyperscaler.
the numbers in the report say that monetizing this specific water advantage could add $20 million to $40 million in pure free cash flow per campus annually.
It's such an elegant value proposition. The hyperscalers need 3 things for AI: massive land, gigawatt power, and abundant cooling water. Legacy markets are tapped out on all 3. LandBridge has all 3 in surpluses.
Plus the base revenue for acting as the landlord. Every 1 gigawatt of deployed data center capacity is projected to yield $10 million to $20 million in FCF for LandBridge.
Strictly from the surface leases and power royalties.
Right. But okay, let me play devil's advocate here.
Yeah.
Let's apply some heavy skepticism because we're throwing around astronomical numbers, 15 gigawatts.
It's the equivalent of powering multiple major cities.
Exactly. It's multiple nuclear reactors worth of output. And they want to put this in the harsh desert of West Texas.
Yeah, that's the hurdle.
If you're a network engineer at Amazon or Microsoft, your job depends on 5 nines reliability. 99.999% uptime. If the power sags for a millisecond, the training run corrupts, and tens of millions of dollars evaporate.
Oh yeah, it's catastrophic.
So how can LandBridge possibly guarantee that kind of stability out there, especially with the ERCOT grid's history of, well, totally failing during extreme weather?
It's the ultimate execution question. And management knows they can't just plug a 3-gigawatt campus into a local ERCOT substation and hope for the best.
The queue to even connect to ERCOT takes years anyway.
Right. So the strategy pivots to building unprecedented self-contained moats. They are physically isolating the risk away from the Texas grid.
So this is island mode.
Exactly. Early development at Alpha Digital will be powered entirely off-grid. They are rapidly deploying highly efficient, localized gas turbines directly to the pad site.
Island mode bypasses the ERCOT waitlist and protects the servers from grid instability.
But, and here's the kicker, running gigawatt turbines in isolation means you need an absolute ironclad guarantee of fuel delivery. If the gas pipeline freezes, the turbine dies.
Right, which brings in the broader 5-point ecosystem again. They are developing a massive 100 BCF natural gas storage facility near the Waha hub.
Yes, the Waha strategy is brilliant.
For the listeners who don't follow energy markets, the Waha hub is legendary. It frequently sees negative natural gas prices.
Negative $20 sometimes.
Yeah. Because the operators are drilling for oil, the gas is just a byproduct. And there aren't enough takeaway pipelines to the coast, so they literally pay you to take the gas away so they don't have to flare it and get fined.
And 5-point is perfectly positioned to exploit that. They are building storage on the physically constrained side of the hub. They can absorb massive volumes of gas when prices go negative.
They get paid to procure their own fuel.
Exactly. But more importantly, for the data centers, this 100 BCF cavern acts as a colossal geological battery.
Capobianco said it guarantees 100 days of uninterrupted fuel supply for a 1-gigawatt campus, right?
Yes. If the whole Permian network freezes over, or ERCOT has rolling blackouts, the campus doesn't even blink. The turbines just pull from the 100 BCF reserve. That's how you guarantee the 5 nines uptime.
So it's not a neighborhood. It's an entirely self-sustaining fortress. Own power plant, infinite fuel, captive water supply.
But a fortress still needs a bridge to the outside world.
Right. You can compute all the data you want, but if you can't export the weights and models, it's useless, which is where the fiber superhighway comes in.
West Texas isolation is great for land, terrible for network connectivity. So PowerBridge is actively engineering a 1,200-mile redundant underground fiber optic ring.
This isn't just normal telecom wire.
No, it's a dark fiber backbone. It's specifically designed to link these remote fortresses directly to Tier 1 network hubs in Dallas, El Paso, and Denver.
Ultra-high bandwidth, low-latency connective tissue. It brings West Texas into the global cloud. The scale of this infrastructure layering is wild. Fiber trenches, gas lines, water mains. But let's talk about the surface area. The Alpha campus is 3,000 acres. Even if they build all 5, that's maybe 20,000 acres total.
Out of 315,000.
Right. What is happening on the other 295,000 acres? Are they just sitting empty as buffer zones?
Absolutely not.
Yeah.
And assuming that completely ignores the core philosophy of management. This leads us to industrial stacking.
Or revenue layering.
Right. It's the aggressive practice of hyper-densifying that SE metric by stacking multiple non-competing industries on the exact same physical acre.
They view the land in 3D, occupying every layer without spending their own capex.
To visualize this, imagine a standard 640-acre section, 1 square mile. 10 years ago, you'd be happy with a couple pump jacks and a dirt road paying a small surface fee.
Sure.
Under LandBridge's model, they dissect that square mile entirely. They lease the northwest corner for a high-density multi-well pad. Right next to it, WaterBridge builds a massive water handling facility.
But the land above those buried water pipelines is technically still unused.
Exactly. So they lease that exact surface corridor to a third-party developer for a solar array. And since solar is intermittent, they lease the adjacent acre for a high-density battery storage unit.
It's like playing Tetris with industrial infrastructure. You're squeezing every drop of value out of the dirt.
And the yield is staggering. Let's look at raw materials. Modern hydraulic fracturing requires an astronomical amount of frac sand.
It used to be shipped in from Wisconsin, right?
Yeah, but now operators demand in-basin Permian sand. The reports note that leasing a portion of their surface for a local sand mine yields an extraordinary $8,000 to $10,000 per acre in royalties.
Wow. And then you have caliche.
The cement of the oil field.
Right, foundational limestone for all-weather roads and rig pads. LandBridge owns the caliche on their land, and those sales have compounded at a 44% revenue CAGR since 2022.
They're literally selling the dirt off the land to build the roads to access the land.
It's brilliant. And the renewables are moving fast, too. They have a 350 megawatt battery storage partnership with Samsung C&T.
And they just sold a 3,000-acre, 250-megawatt solar project in Reeves County.
So they're layering oil, water disposal, sand mining, solar, and batteries, exponentially multiplying cash flow without deploying their own capital for the panels or mining equipment.
It's the ultimate expression of the vortex of value.
But, okay, let's pump the brakes. This sounds like a perfectly orchestrated symphony. The 3D models look flawless, the SEE targets are great. But what is the catch? The market isn't valuing them as a tech darling yet.
No, the market is highly skeptical.
Yeah.
And we have to address that reality objectively.
I think investigative analysts explicitly call it the commitment gap. This is the multi-billion-dollar elephant in the room.
Right. As of these reports, LandBridge and PowerBridge do not have a single signed power purchase agreement, a PPA, with a hyperscaler.
No Microsoft, no Amazon, no Meta. No one has formally signed a binding lease for these campuses.
It's the critical vulnerability in the short-term thesis. They are executing a build it and they will come play. They are ordering the electrical switchgear, trenching the 1,200 miles of fiber, breaking ground on heavy civil engineering.
All before a tenant is locked in.
Right. Now, PowerBridge bears that specific CapEx risk, so LandBridge's balance sheet is somewhat protected. But the entire blue sky upside relies on this gamble paying off.
Building gigawatt infrastructure in the desert without a buyer is a massive financial risk.
And part of the hyperscaler hesitation comes from what the analysts call latency realities.
Latency being the physics of network traffic, the exact time it takes data to travel from Pecos through the fiber to the end user and back.
The physical distance to Dallas creates a baseline latency of roughly 5 milliseconds.
Which, in the tech world, can be an eternity.
A 5-millisecond delay completely disqualifies you from hosting legacy synchronous cloud apps, high-frequency trading, real-time gaming.
You physically cannot operate those out of West Texas. You have to be in Dallas or Asheville.
Exactly. But AI training architecture is fundamentally different. Training a massive LLM is asynchronous, heavy batch processing. The GPUs just crunch numbers for months without needing round-trip interaction with a consumer.
So for AI training, 5 milliseconds is perfectly acceptable.
Yes, they're making a very specific binary bet on the continued growth of the AI training market.
And to bridge this commitment gap, the sources say management is using a concession strategy.
They're willing to be very creative to get that first anchor tenant.
Right, up to and including potentially selling land outright. So I ask you, the listener, would you build a multi-billion-dollar neighborhood hoping a tech giant moves in? And if management sells land outright just to secure a tenant, doesn't that undermine the whole capital-light leasing a CE model?
It's a very valid critique.
Yeah.
Selling fee simple surface rights terminates the compounding royalties on those specific acres forever.
Right. So why do it?
Because Capobianco and his team know that getting the first major anchor, like Amazon or Google, is the essential catalyst.
Once one giant commits, it validates the whole island mode architecture.
Exactly. It de-risks the geography and triggers a feeding frenzy for the adjacent parcels.
Yeah.
They've seen this play out before with the Cumulus data center project in Pennsylvania.
And they do have some momentum. The reports highlight a letter of intent with NRG Energy for a 1 gigawatt campus. NRG is already doing the complex air permitting for the turbines.
It's not a binding PPA, but it's hard evidence that major power providers believe the island mode works.
So we have to weigh these execution risks, the commitment gap, the latency, the land sale concessions against the legacy business. Which brings us to the final verdict from the investigative report.
Despite the risks, LandBridge is rated a compounding buy. Why?
Because the safety net is basically solid gold.
It really is. The existing legacy business surface rights, caliche, water royalties generated $177 million in EBITDA in 2025.
Without a single data center operating on their land. The baseline is wildly profitable on its own.
That fortress-like baseline is why analysts call the 15-gigawatt strategy a massive call option on the AI economy.
Let's talk projections. Assuming a very conservative 15% organic growth rate on just the legacy business, adjusted EBITDA could reach $750 million by 2035.
And with their stated M&A strategy, Targeting $25 million in EBITDA acquisitions annually, it could surpass $1.2 billion.
And again, that assumes zero revenue from the tech campuses.
Zero.
So the worst case scenario is you own an incredibly profitable, high-margin monopoly on dirt in the Permian Basin. It pays a dividend and buys back stock.
And the best case scenario, the legacy business prints cash, while those 315,000 acres become the foundational bedrock of global AI computing.
Generating another $150 to $300 million in pure FCF from digital leases, plus tens of millions more just letting tech companies evaporate groundwater to cool their servers.
You're buying a highly insulated, fee-based industrial land manager that happens to be holding a lottery ticket for the digital frontier. If they land the hyperscalers, they detach from oil and gas multiples and start trading at tech platform premiums.
It's totally asymmetric. The downside is structurally floored. The upside is uncapped by the AI.
It's a surreal evolution of the Texas land baron. And I wanted to leave you with this final thought.
Go ahead.
Think about the geopolitical balance of power. What happens when a regional land and water management company in West Texas suddenly becomes the ultimate gatekeeper of advanced AI capabilities?
Wow.
If data and compute are the new oil, then the people who control the grid-isolated power, the subterranean water, and the physical lando, they are the undisputed new barons of the digital age.
That's an incredible reality to consider. We started looking at flat dirt and ended up analyzing the gatekeepers of global algorithmic dominance. Risk defined, portfolio protected.